Here we go. How bad is it this Wednesday morning? We'll tell you immediately. Right from the start, we are down 387 points, and every single one of the Dow 30, except for Merck, they're all lower, every single one of them. 382 down on the Dow Industrials. The S&P 500 down 1.4%, that's 53 points. The Nasdaq Composite down 1.8%, that is over 200 points. Big Tech down all across the board. Apple 142, Amazon 106, Meta 160, Alphabet's down nearly $40, and Microsoft has dropped below $250 a share. This market sell-off coming on those inflation numbers, 9.1% consumer price inflation over the past year. That was a real shock. Good morning, Susan.
Good morning.
Which sectors get hard hit?
Well, obviously tech. You're seeing that right now. We're down about 1.5%, at least 2 for the Nasdaq 100 and the largest technology stocks there. So you saw that spike in 10-year yields, 75 basis point hike, pretty much guaranteed later on this month. 80% probability of another 75 basis point hike in September. So that's 3 jumbo rate hikes in a row. Also, there's a almost 50% chance now of a 100 basis point hike later on this month.
What tells you that? What tells you this expectation?
Fed funds futures, that's what I'm looking at.
That's what you're looking
at. And that's telling me that Wall Street is expecting a near 50% probability of a 100 basis point hike, which would be the highest since going back to the Volcker years in the 1980s.
Right.
Let me ask you this, though, because I'm trying to figure out what that means and what that signals for the stock market if they just rip the Band-Aid off. We all know inflation is at its highest in 40 years. If they go 100 basis points later on this month, I think stocks would actually rally.
I think you're right. Because that would be almost doing a Paul Volcker.
Right, and that's
stamp on it
and that's
now.
your superpower because you have historical context. You've seen this again, and you know history repeats itself. So do we just rip the Band-Aid off, going Paul Volcker, shock and awe, saying we're going to get this under control? And I think that would actually send a positive signal to Wall Street, thinking maybe, look, if we raise interest rates this high in the short term, we could have room to cut into 2023.
Is Jay Powell that tough a guy?
I think he's made it very clear that inflation is his focus right now. And I was reading a Wall Street Journal article yesterday, and again, your superpower is historical context. Do you think we have that ebb and flow in the 1970s where they raise, they cut, and that's when the stock market kind of went flatline during that decade until Volcker came in, and then he went shock and awe, and that's when you saw that bull market run in the 80s.
Without a shock and awe 100 basis point jump in the federal rates. Without that, you may well get a stock market that stumbles along for a few years at a low level, just like the 1970s.
So I heard your Eddie Gabor interview there, and I'll tell you that Wall Street expects that maybe we'll get to 3.5%, probably more now with that 9% inflation print this morning, 3.5% by March of next year for interest rates. And then Nomura says, and I think Wall Street's on board, that if we do get into a recession, I mean, probability is still all over the place. Probably more likely, if you look at the inversion curve right now with the 2s and the 10s at the widest gap since 2010 right now. So that tells me that Wall Street's pretty much pricing in a recession, at least in the next 12 months. But do we have room to cut interest rates in September next year?
Good question. We'll probably answer that next year, I guess.
I think Wall Street is saying if you're going to have to raise interest rates so sharply, so quickly, we're probably going to slow down growth. And how much does growth slow down where then you have that optionality to start cutting to get us out of negative growth?
Do bank stocks go up when rates are rising?
Yeah, and you'll see that later on this week. I think tomorrow is when the bank earnings start. And so they'll usually make more money on loans with higher interest rates. Also, trading volatility, bad for us because we can't stomach those declines. Good for investment banks since they make those commissions. As I mentioned to you, I think the dollar is going to be impacted. That's going to be a running theme throughout the entire earnings season.
Should go up, shouldn't it?
Well, the dollar is at the highest since 2002 because the Fed is hiking rates so quickly in the short term.
So it should go up some more?
Absolutely. And think about what that means, though, for corporate earnings when you bring it back into U.S. dollars. It looks less if you're sitting at 20, 30-year highs against the yen. I think you're at parity for the first time in 20 years versus the euro.
Okay. What about the inversion of the yield curve?
As I mentioned to you, the widest gap we've seen, which is a recession indicator, as you know. So the 2s and the 10s right now, 15 basis points plus. That's the widest gap we've seen since 2010. And as I mentioned to you, I think it's pretty probable in Wall Street's view right now, maybe a 60 to 70% probability we could see 2 quarters of negative growth in a row.
Okay, let's move on to individual companies, like Delta. Whoa, down 7%. They're the first airline to report this morning.
And
what happened?
I also want to ask you what this means from a consumer perspective, because you do have Delta.
Don't ask me. Don't ask me.
Again, superpowers historical context. History repeats itself, so you know. So Delta made money instead of losing money for the first time since the pandemic. Sounds great, but Wall Street had pretty high forecasts for Delta and the airlines. And the reason is that they're talking about high operating costs, meaning high jet fuel costs. And we know that we're still, I think, close to $100 or so for West Texas. And you heard Ed Bastian, the Delta CEO, saying that high costs will be around for the rest of this year. They're still forecasting a meaningful profitability for this year. But is airfare demand enough? And will it continue with higher interest rates and a slowing economy to continue the bottom to, I guess, surpass costs for airlines?
I guess the market thinks otherwise. All the airline stocks are way down today.
Well, Deutsche Bank says we're going to see record airline earnings for the 11 U.S. air carriers in this quarter, $53 billion, which maybe it'll be great for the springtime. Let's see how it rolls out throughout the rest of this year.
Can we bring up Stitch Fix?
Yes.
I want to ask you, why does Stitch Fix, I think they're up today. Yeah, they are. They're up. Yeah. Now, this is a personal styling company. It's been explained to me. Okay.
Yes.
Why would a personal styling company go up 5.5% on a day when we report 9% inflation?
I'm so fascinated by the fact that you chose Stitch Fix, which is a personal styling online company.
You told me to, you know it.
Well, okay, I think it's encouraging for the market because we've been talking about the dry up in venture capital funds and the fact that private markets and private funds saw the downturn and started cutting back on their spending before the public markets, right? So the fact that Bill Gurley, who is probably one of the most famous venture capitalists, the guy who kicked out Travis Kalanick at Uber, he went in to buy and spend to buy another 1 million shares in Stitch Fix.
Okay, yes, that's a plus, I would say.
The fact that you have VC funds deploying money, I think that's encouraging for the markets.
Okay, Susan, thanks very much. All good stuff. Let's take a look at some of the market performers here. First of all, the 10-year Treasury yield, 3.01%. Got it. The price of gold, down some more. I think that's like 22-month low, actually.
Do you think that's a recessionary indicator, too?
It can be used as that. Yeah. Yes, it can. Bitcoin is desperate to stay above $19,000 a coin. It's barely above it now. Crude oil down, well, up 12 cents, but $95 a barrel. Nat gas not doing that much. Yes, it is. It's up 5%. The average price for a gallon of regular, $4.63. In California, it's still just over $6 for regular.